Hello and welcome to Hard Money. I'm Natalie Brunell. The White House says we're not in a recession, but there are blaring signs of exactly the opposite across the board. Let's start with a look at jobs and labor demand softening. The latest job openings and labor turnover survey, otherwise known as JOLTS, shows that job openings fell by about 600,000 in June, from 11.3 million to about 10.7, with some economists suggesting the labor market has peaked and unemployment will tick up. According to Zero Hedge, this drop in hires marks the third biggest on record, with only COVID coming in worse. And look at the rate of unemployment claims surging. According to this chart shared by investment advisor Charlie Bolello, after hitting a record low in April, a 4-week average of initial jobless claims has increased by 46% to its highest level of the year. Meanwhile, in housing, which we will go more in depth on later in the show, we just saw the biggest drop in average new home prices since 2008. That's according to the Fed. It also marks the second largest monthly decline in 50 years and the fastest decline from the high on record. If you look at housing and labor markets side by side, a drop in home prices usually leads unemployment, which is exactly where we're at. So, no recession? And let's talk about bonds quickly, where we're seeing a continued yield inversion, another indicator that shows tough financial times ahead. The spread between the 2-year Treasury and the 10-year Treasury continues to be inverted, and this metric has historically foreshadowed a recession. It also signals the Fed may not have much room left to raise rates. They can either hike and accept higher unemployment or lower rates and accept higher inflation. When the yield curve inverts, it suggests that investors expect the Federal Reserve to cut interest rates in the future. For example, investors wouldn't be willing to lend money to the government at 2% a year for 10 years if they could get 3% for lending for just 2 years, unless they expected to have to accept lower interest rates between years 2 and 10. And if they expected lower rates in the future, it would likely be a signal that they expect a weaker economy in the future, because that's usually what causes the Fed to lower rates. Okay, so what's the big picture? As economic conditions continue to deteriorate, Americans are finding it harder and harder to afford the cost of living. In fact, according to CNBC, 61% of Americans are living paycheck to paycheck, including 36% of those earning $200,000 or more. And look at the rate of savings. Nearly a quarter of American households have no emergency fund. And with our interconnected global economy, many countries are suffering far worse cost of living crises. Take a look at some examples highlighted by the Thomson Reuters Foundation. In Mexico, price of corn is at a 9-year high, and vegetable oils are up 23%, which are essential for so many businesses. In Brazil, consumer prices up 12%, but average incomes nationwide have dropped 7.2% since 2021. And in Venezuela, consumer prices shot up 170% in the last year. Every nation dependent on the dollar continues to see prices explode. Before we move to Bitcoin, a quick touch on the growing energy crisis. Prices of gas and electricity are skyrocketing in places like Germany because the nation remains too reliant on energy from Russia. For more than a decade, some countries, including the US, underinvested in commodity capex and infrastructure to meet growing demands. But elected leaders continue to think we can make a sudden shift to green energy without the technology ready to provide it. Those promises will be difficult to keep. Listen to Vice President Kamala Harris addressing the climate and energy issues at Florida International University.
And that is why last year we set an ambitious goal. Our nation will cut our greenhouse gas emissions in half by no later than 2030. And by no later than 2050, we will reach net zero emissions.
An ambitious goal indeed. As investment strategist Lynn Alden has pointed out many times before, we spent decades focusing on efficiency rather than resiliency, and now that has a cost that can't be fixed overnight. All right, now to some Bitcoin stories we're following this week. Bitcoin megabull Michael Saylor announced that he will be transitioning from MicroStrategy CEO to the role of executive chairman. Phong Le, who has served as president since 2020, will become the new CEO, and Saylor had this to say about the switch-up. Quote, "I believe that splitting the roles of chairman and CEO will enable us to better pursue our 2 corporate strategies of acquiring and holding Bitcoin and growing our enterprise analytics software business. As executive chairman, I will be able to focus more on our Bitcoin acquisition strategy and related Bitcoin advocacy initiatives, while Phong will be empowered as CEO to manage overall corporate operations." Now, some people have been questioning whether Michael Saylor was pushed out of his role as CEO, and this is what he had to say.
So just for the record then, to those who are speculating that you were pushed out of this role, is there any truth to that?
No. First of all, it's my idea, Emily. And second of all, Yeah, some people say it's their idea. I'm the controlling shareholder of the company. I have the majority of the voting stock. And so I've been planning to place Fong as the CEO since we made him chief operating officer. That was like 2018. The plan predates my infatuation with Bitcoin, Emily. It goes back that far.
And another news, Saylor appeared on the Not Investment Advice podcast to explain why Ethereum is unethically violating securities laws. Take a listen to this.
You can't keep changing the protocol. That's the problem. If you change the protocol, then you probably instantiated a security. If it's a security, you're trading it illegally, right, on unregistered exchanges without a license to trade a security, and you haven't disclosed all the risk factors on the security. So it doesn't work as money.
Meanwhile, the SEC has charged 11 people for allegedly running a crypto-based pyramid scheme. The SEC charged the founders and promoters of Forsage for creating and promoting a fraudulent pyramid and Ponzi scheme. The firm raised more than $300 million from retail investors worldwide, and Forsage claimed to be a decentralized smart contract platform that would allow people to enter into transactions via smart contracts that operated on the Ethereum, Tron, and Binance blockchains. A court in the United Kingdom has ruled that Craig Wright, the man who claims to be Satoshi Nakamoto, did advance false evidence in his case against podcaster Peter McCormack. The judge awarded Wright a grand total of £1 which is about $1.25. The legal battle was over a 2019 discussion, which was then posted on YouTube, in which McCormack said Wright is not Satoshi and called him a liar and a fraud. Wright claimed those comments caused him financial damage after he was disinvited to speak at various events and conferences. Nearly 75% of retailers plan to accept cryptocurrency payments within the next 2 years. That's according to a new survey by Deloitte. 2,000 executives within the retail industry expect payments using cryptocurrencies to become much more common, and 50% have already spent money setting up an infrastructure for digital payments. The survey predicts that retailers accepting crypto will most likely be using stablecoins, which are pegged to the dollar. Nigerians are buying so much Bitcoin, it is now being blamed for a decline in the value of their local currency, the Naira. That's according to one of their government officials. The Naira has been collapsing recently against the US dollar, and that has many people in Nigeria rushing to buy Bitcoin to protect their money. Crypto exchanges in Nigeria saw a 250% increase in trading volume over the past several weeks. And finally, with the Bitcoin tourism boom seen in El Salvador, Honduras is hoping for a similar effect. The country has launched Bitcoin Valley in the tourist area of Santa Lucia. 60 businesses in the small mountain town will now accept Bitcoin as payment. They will also get trained on how to market their products and services. All right, that does it for Hard Money Headlines. Ahead, we speak to Price of Tomorrow author Jeff Booth about the state of the economy and why homes have become the primary savings account for so many Americans. Plus, he's working on an article that establishes the important difference between Bitcoin and crypto. Don't go away. Welcome back to Hard Money. Joining me now is author of Price of Tomorrow, entrepreneur, and general partner at Ego Death Capital, Jeff Booth. Jeff, so great to see you.
Great to see you too, Natalie.
We're going to be focusing some of the show on housing. And in this current system that is built on credit and requires inflation, the cost of real estate has really become unaffordable for a lot of people. But you envision something different, deflation under a Bitcoin standard. Can you tell us what the Bitcoin standard would help with when it comes to affording a house these days?
Yeah, housing has been used as a store of value to protect people from the inflation rate, and what ends up happening is more and more people trying to escape that their money losing value or racing into housing as a store of value, and concentrating more and more. And capital is racing to that as well. So large funds are investing in real estate and competing with home buyers for that real estate, not as a utility, but as a store of value. What Bitcoin changes in that whole paradigm is priced in Bitcoin, housing will fall to its utility value over time. So it actually makes housing more affordable for people to live in. But that's measured in Bitcoin. In the existing fiat system, if you measure in the existing fiat system, assuming there's more and more monetary easing, housing will continue to rise in that. It'll just lose value in Bitcoin.
And, one of the things you talk about is how that really contributes to more and more wealth concentration. But why are politicians so afraid of deflation?
Because the entire credit-based system we live in would collapse spectacularly with deflation. And probably that's why why you have to have a separate system solving the problem instead of the system. The system can't solve the problem from the system. And what we measure everything that we live in from that system, which is really built on manipulation of money. And every other economic consequence is sitting in that system. And you can imagine we wouldn't, even us as voters, we wouldn't vote for a politician to let the entire system collapse and every bank fail. That would be a catastrophe, that there would be a lot of human suffering in that. And so the system must, no matter if you're left or right, whatever political ideology you have, the system must continue to print money over time and make this problem worse from the system. And Bitcoin is a different system that competes on that system from outside the system. And and as I've said many times, it's a bridge to the other side because we can't solve the problem from the system.
Yeah, we need that parallel system. Well, CPI is 9.1%, but real estate across the country over the last 2 years with monetary expansion has gone up 30, 40, 50% in some cities. Now we're finally seeing that reverse a little bit. Is that a sign of a recession, Jeff?
Yeah, we're in a recession, and it's going to turn into a depression unless the Fed pivots really quickly. Last week, when you saw markets reverse, it was really on Powell's comment that said we're watching for a slowdown in economic activity. And that sets him up for a pivot at his Jackson Hole meeting at the end of August. And whether he pivots or not, it has massive consequences for what the U.S. looks like and what the rest of the world looks like. Because unless there's a pivot soon, the economic consequence of not pivoting means tax revenue falls, debt to GDP explodes. You turn into a debt crisis, a sovereign debt crisis, with essentially the currency that is the backing currency of the world. And so this has a lot of implications worldwide, and why the whole world is watching when a number of people get together and destroy currency to run all of other economic value. You kind of realize we're well past this movie ending well.
Well, another thing that a lot of people are watching is unemployment. I know you have your finger on the pulse of so many different companies. You talk to a lot of entrepreneurs and executives. What's happening with unemployment?
Well, unemployment is a lagging indicator. And again, just about every company I'm involved in and many that I'm aware of, a finger on the pulse, are talking about layoffs. And if there is a credit contraction, if the credit contraction adds up to any more time, there's going to be a boatload of layoffs hitting the market. As those layoffs start to accelerate, those people all have mortgages that they can't pay as well, into housing declining in value, and it sets up a very real credit crisis that accelerates. And that's kind of what I'm talking about. Once that credit crisis starts to accelerate, it's harder and harder to stop it. And similar to 2008, and then similar to 2020, what stopped it is way more monetary easing and way more exponential debt creation created each cycle. And this one would take a lot more than the last two to be able to solve, specifically if it gets too far down the road.
It's hard to imagine the bubble getting even bigger, but really that's what's required under this system, right? Jeff, last thing I want to talk to you about is this article that you're working on, which I think is so important given, every day on the news, they kind of conflate Bitcoin with crypto on all the news shows. So why are you writing an article specifically touching on why Bitcoin is very different from DeFi, Web3, and cryptocurrency at large?
My thesis is money is only information. We don't actually want more money. We want more of what we believe money buys us. So when the entire system is built on kind of manipulation of money, which is the manipulation of information, then society looks through that misinformation and they become confused. And every single person in that thinks they have better information than everybody else. And they're all looking through that misinformation, trying to understand. And at the same time as that's happening, you have a new protocol level technology being built on Bitcoin. And protocols are really hard to understand as well. And so what people are getting caught into is a whole bunch of Ponzi schemes and frauds really in DeFi, in the DeFi space, because of that confusion. And so I wanted to just write an article kind of giving a simple framing on how are they different, why are they different, and what it would look like in a world that was having that misinformation. Why would people be susceptible to getting scammed with that misinformation?
Well, it's such an important message. I had a chance to preview that article, so we can't wait for it to come out. Jeff, thank you so much for joining me today. And coming up on Hard Money, we go in depth on the housing crisis across America.
Oh, hi, I'm Max Patrick. And this, of course, is Plucky. I got a new job. I'm now Plucky's trainer. We're doing some of these sit-ups here. He wants to get as strong as possible for the fiat money apocalypse.
That's right, Max. We're about heading into the fiat money apocalypse, and I'm stacking sats over Swan Bitcoin.
Oh, that's so smart, Plucky. How did you get so smart? Get the Swan app.
In the midst of a pandemic with the money printer on overdrive, housing prices across the country exploded. Phoenix homes up 32.6% on an annual basis. Tampa up 30.8%. Dallas up 27.3%. Everyone talks about inflation, and almost nowhere was it most evident the past 2 years than in real estate.
Case-Shiller housing index is still running above 20%. Nationwide, that's not just hot markets, that's everywhere.
Rents have been going through the roof. Home prices have been rising at unsustainable levels.
The average buyer is priced out of the market, left paying exorbitant rents, while high earners and real estate investors with deep pockets are increasingly the main buyers.
We have an affordability crisis in the United States, and I would say COVID actually revealed and exacerbated an existing crisis, but it's only gotten worse.
These market conditions are compounding wealth concentration as younger people with less means are increasingly unable to enter the housing market, while the wealthier asset owners get richer and richer. But who's to blame?
The Fed's really created a huge housing bubble, and they kind of have to get out of the housing market before that's going to correct.
The housing sector is just another asset class caught up in the Fed-driven everything bubble as interest rates were artificially lowered to near zero. Easy money came pouring in. But the problem with bubbles is they burst. And as interest rates hike, the housing sector has been taking a massive hit.
In America, we worry about the price of gas and bread and everything except housing. When home prices go down, it's a calamity.
The Fed used to not invest in bonds, but in 2020, they decided to get involved in the mortgage market.
This year, home sales have dropped for 5 straight months by over 5%. And with higher interest rates, mortgage payments have almost doubled.
Housing is a very interest-sensitive sector, And higher interest rates, really interest rates that move back toward a more normal level, should act to cool off the housing market over time.
The Fed's so-called soft landing may look more like a wrecking ball to real estate if interest rates keep climbing. But therein lies another dilemma. Turning the money printer back on would reinflate a bubble even bigger, making homeownership even more out of reach for millions of Americans, especially young ones, leaving a fork in the road of our current financial system in which both paths lead to more problems.
What's the problem with the inflation rate in housing being 19%? It's an awful problem for a 22-year-old that's starting their first job, that's saving money to buy a house. But it would be characterized as a benefit to society by a conventional economist who would say, well, asset values are higher because of interest rate fluctuation, and now the economy's got more wealth.
Bitcoin just flips that whole thing on its head. It says we're taking inflation to absolute zero, which in theory would mean a society running on a Bitcoin standard benefit in nearly infinite ways.
The years of monetary expansion and low interest rates bidding up the price of real estate have turned homes into the main family savings account, a savings account based on credit. But what if there was another way for the average person to save money without losing purchasing power over time and without having to become a real estate investor or stock picker just to break even? What if a house was affordable for the average person with a modest income?
We're going to demonetize all the physical property in the same way we're going to demonetize the gold. You still need gold to wear. I have a gold ring on. You still need property to live in, but the value of the property should collapse to the utility value and not carry the monetary premium.
Everybody thinks their house always goes up in value, and they've never asked the question, would my house go up in value without $185 trillion of stimulus over the last 20 years? The answer is simply no. Houses would go down in value or stay constant.
In other words, what if Bitcoin fixes this?
Bitcoin is the ideal money. So if I decide I'm going to sell my second or third investment property and buy Bitcoin with it, the demand for investment properties should decrease, so the price will come down. And so that means that if you wish to buy a first home, it will be cheaper for you.
Welcome back to Hard Money. It is time for our weekly macro segment with Andy Edstrom, CFA and author of Why Buy Bitcoin. Andy, the big news last week was the Fed's 75 basis point rate hike and the release of second quarter GDP data. How has the market continued to digest this information?
Yes, Natalie, as you say, we saw a 75 basis point rate hike last week. That's 0.75 of a percentage point. And this came on the heels of the same size rate hike in the prior meeting, which puts us on track for the fastest increase in interest rates coming out of the Fed since the 1990s. Considering that fact, I'd say that financial markets took the news rather well. Risk assets like stocks are up since the announcement. Bitcoin is up. And I think that reflects really people's expectations, investors' expectations about what could be coming out of the Fed after this rate hike. There's discussion of a pivot or a partial pivot in Fed policy, which is to say that Powell made some dovish comments about the interest rate now being in the range or in the middle of the range of what he considers to be neutral with respect to inflation. So that implies that the Fed may have already gotten most of the way toward their goal of raising rates to halt the advancement in inflation. And of course, we'll see what happens. But I think that's why the markets took the news rather well.
Okay, Andy, so what are the numbers showing us in terms of recessionary indicators?
The news on recession indicators is not so great. The yield curve has further inverted, which is to say that short-term interest rates are even higher now than long-term interest rates. That is even higher than they were before. The curve has been inverted already, and that inversion has become more pronounced. This includes the difference between 2-year Treasury yields and 10-year Treasury yields, as well as the difference between 3-month yields and expected 3-month yields 18 months from now, which we think is Chairman Powell's favorite recession indicator. Existing home sales have dropped pretty dramatically. They're down 29% since January at this point. Real average hourly earnings are down. Consumer sentiment is down to near or at all-time lows, and oil is down. So the fact that we've seen 2 consecutive negative GDP growth quarters, which is to say 2 quarters of GDP shrinkage, the economy shrinking, it's suggesting stronger indications along with the current data that either we are already in a recession or will be entering one soon.
All right, so the Fed's next rate decision will come on September 21st. And while a lot can happen between now and then, what is the market expecting the Fed to do in September?
Yeah, so one of the Fed's key monetary policy tools is what's known as forward guidance. And forward guidance basically means telling the public what they expect to happen. That is to say, the Fed's telling the public what they expect to happen. And that expectation, or the communication of that expectation, essentially becoming a self-fulfilling prophecy, because markets believe the Fed. The Fed has credibility, and investors take actions to cause what the Fed expects to happen to actually happen. However, the Fed has been, frankly, backing away from this policy, it seems, or at least that's what's indicated by recent statements from Powell and other Fed officials. It seems like the Fed is now going to become more data dependent. Those are the key words, which is to say they're sort of admitting that they're not sure what the optimal policy for interest rates is going to be, and that they're just going to see how the economic data and the inflation data and the other data that they're watching come in, and then act accordingly. So anyway, the markets, though, always have expectations. And right now they're pricing in about a 50 basis point rate hike, which would be a reduction in the speed of rate hikes versus the recent 75 basis points. So that's what we're seeing from market participants at the moment.
All right, Andy, what are you going to be focused on the next couple weeks?
Yeah, so I'm still laser focused on inflation. Next week, we get the July CPI inflation number. And although that may be somewhat lagging versus indicators like commodity prices, which we've seen coming down recently, I do think that the CPI number is going to be what the media are focused on. Investors are going to care about it. And the trajectory of inflation implied by that number, i.e. whether it's speeding up or slowing down or reversing, is probably going to play pretty strongly into people's views on both the economy and financial markets.
All right, Andy, thank you so much for all that important information. It's always good to see you. All right, that does it this week for Hard Money. Our goal on this show is to cover the biggest headlines impacting Bitcoin and the global economy, plus offer you one-on-one interviews straight from the biggest names in the space. I'm Natalie Brunell, and I'll see you next week.